Hi, hello, welcome to the Ampac Business Capital Borrower Best Practices presentation. My name is Ian Aguilar. I'll be your host. I am the Small Business Development Coordinator here at Ampac. And let's dive right in. We're going to be going over what a borrower should be doing when looking for a business loan, specifically through the lens of an SBA lender. So do keep that in mind. This is not how it would go for traditional commercial banks like Wells Fargo, Bank of America, US Bank, but it does give you a good idea. So what does the SBA look for and who can apply for an SBA loan? So you have to be a small business as defined by the SBA, which we'll go over in a minute. You have to be in operations, organized for profit, and have a presence within the US. So if you're international or headquarters internationally, you just need a location within the US. So small businesses you can generally safely say that any business with less than $15 million in assets and have less than 500 employees are generally going to be safe to apply for a loan through the SBA. They do have industry-based size requirements, but for our general purposes here today, less than $15 million in assets and less than 500 employees. So you will not be considered eligible if you're a nonprofit, if you're a financial services or business that's primarily engaged in lending, so something like Ampac couldn't apply for an SBA loan. Passive businesses owned by developers or landlords, so these are investment properties. We will not finance those as well. Life insurance carriers, pyramid schemes will not be eligible. Small businesses that obtain more than 33% of their revenue from legal gambling activities, and businesses that are engaged in any activity that are considered illegal at the federal, state, or local level. This is primarily targeted at cannabis industries here in California, where it's legal in the state, but not legal elsewhere. So that's an example. So the other thing that they take into consideration in how they categorize you is, are you a startup or are you a seasoned business owner? So you will be considered a startup by the SBA if you have less than 2 years of filed tax returns. So anything less than that, you're going to be considered a startup, and these kind of describe what kind of situation you might be looking at. You'll be a seasoned business owner if you have more than 2 years of tax returns. That's how the SBA sees you. So when a lender talks about needing that my business needs to debt service or cash flow, what are they talking about? Well, what they mean is cash flow is the way money generated by your business moves in and out of your business. So cash in is going to be your sales and income from whatever products you sell or services you provide. Your cash out is going to be your cost of goods sold, your expenses, and your overhead. So the total of this, or the equation, would look like I have my cash in, subtract that from my cash out, and the amount left over is my cash available to debt service. Now, what's debt service? Debt service is the amount of interest you pay on your debts over the course of a year. Here's an example of how we would calculate debt service. We have a mortgage payment that's at $1,000 a month. We have a credit card payment that's at $300, and we have a business loan that we're paying off currently that's at $2,000. Total this out, monthly we pay $3,300. Multiply that by 12, we get the annual debt service, which is $39,600. So let's put this in practical terms for us. Let's say we have a business owner that makes $140,000 in revenues, and they have $100,000 in expenses. So we go into debt service ratio. This is the basis of how we would be looking at a business and determining whether or not they'd be eligible for a loan for a seasoned business owner. So we have that previous example. So we have $40,000 left over after operating our business. So our cash flow into the business is $40,000. We have a debt to be serviced of $39,600. So our total DSR, or debt service ratio, is 1.01. Now, what does a lender think of when they see this ratio of 1.01? Traditional lenders would think you have a difficult time paying off this loan because for every dollar that you spend or that you earn, you have to spend basically a whole dollar back. SBA will look at this and say, hey, you could pay back the loan, so we'll consider it, because they want to help your business grow. They just want to see how much it would grow from this business loan. Traditional lenders are only really concerned with, hey, can you pay us back? So that's why if you're seeking a traditional loan, as well as an SBA loan, you should think to minimize expenses as much as possible and maximize revenue. So that way you generate the highest DSR possible. So that way you can get approved a little bit more easily. So another aspect of getting a small business loan is called an equity injection. So an equity injection is how much you as the borrower need to put into the project that you're working on in order to pitch in to your business. This is what lenders will ask for to demonstrate your commitment to the business's success. So here, imagine you have your friend who says, hey, I have this great business idea and it's going to be so profitable, you have no idea. And he comes to you with this and you say, oh my gosh, this is a great idea. Let's get to it. How much are you putting in? And they just take a step back and say, whoa, why would I put in my money to this? That immediately calls into question how committed they are to the business's success if they're not willing to put in their own money. So this usually totals out to be between 10 and 20%. It can depend on a variety of factors, including the lender's credit policy, your personal credit, your DSR, your industry. A lot of factors can go into this. So, but safe range 10 to 20%. Startups, you're probably going to be looking closer to 15% or more. So it's not, an equity injection isn't always asked for, but be wary if they are not asking for it. So if you're not providing an equity injection, it usually means your business is really strong if it's not being asked for, or you have collateral for it. So if a lender isn't asking for an equity injection and they're asking for collateral, which is usually a business or personal asset, you have to consider the fact that if the loan goes into default, you'll have to liquidate or sell that collateralized asset. Usually for small business owners, it's their house serves as collateral. So they will sell their house if the loan goes into default. So here's an example of what an equity injection payment might look like. A borrower requests $50,000 for a loan. They're asked to provide 10% equity injection, and so they must offer up $5,000 before the bank will fund the other $45,000. So I've decided I know I can debt service ratio. I know I have my debt service. I know what project I'm going for. I know exactly what I need. So how does it look to putting together a loan package? Well, here's a pretty universal pre-qualification package. If you're a startup or if you're a seasoned business owner, this is what you're going to need to give us. You're going to need to give 3 years personal income tax returns. And there are some cases in which you might have less than this, like say if you're a legal permanent resident or a green card holder. So that can be up in the air for those particular types of business owners. 3 months personal checking account statements. This just shows us that you have money coming into your personal side. We have the SBA Form 413. This is a personal financial statement, basically detailing your personal assets and your personal liabilities, like your mortgage or rent. It also serves as a go-ahead for the lender to check your credit. Now, know this is a hard credit check because a lender is inquiring as to what your credit is, and that services your creditor to think, oh, hey, they're probably going to be getting a loan. That can be kind of scary for creditors. So just keep that in mind. And then you also need to provide a working capital explanation. So what is this money being used for? Basically, tell us what the loan is for. If it's for debt refi, if it's for leasehold improvements, if it's for equipment purchases, let us know what it's for and detail how much it's going to be. You would never be able to walk into a financial institution and say, hey, give me $500,000. And they ask you, okay, what is it for? And you say, I don't know. No one's going to fund that. So if you're a startup, this is some additional information that you'll need to provide along with all of the other things. You're going to need to provide a business plan, a statement or a document that basically presents your business. How does it make money? What are your revenue streams? What are your expenses going to look like? And then you're going to need to take 3 years or 36 months of projections, and basically how much money you're going to make over the course of 36 months, how much are you going to have in expenses, how much are you going to keep at the end of it. So that helps an SBA lender determine whether or not that your business is going to grow from the loan. You're going to provide any business tax returns that you might have. So 1120, an 1120S, a 1065. If you're a sole proprietor, you can file a 1040 and you'll provide the Schedule C statement of that tax return. Any financial statements that you have, a business debt schedule, a business balance sheet, and a year-to-date profit and loss statement. And so finally, we get to our seasoned package owners or our seasoned business owners. You're going to provide 2 or 3 years of tax returns. So let's say if you started in 2011, you've been at it a while and you want to go for a loan, you're going to provide the 3 most recent years of tax returns. So that's going to be 2020, 2021, and 2022. And you're also going to provide a year-to-date financial statement of your profit and loss, your business debt schedule, and your balance sheet. So that'll be scheduled out from whatever January 1st of whatever year it is, all the way until the most recently finished month. So as of today, it is July 26th, 2023. I am not going to make my financial statements out to July 26th, or sorry, July 26th. I'm going to make it out until June 30th. So my financial statements that I provide the bank are going to be made from June 30th. So January 1st to June 30th of 2023. Now, this is just some loan safety tips. So we want you to avoid having a bad loan on your balance sheet. So what are some green flags as far as lenders are concerned? They must be transparent, like AMPAC's doing right now, talking about everything that goes into a loan. If they pressure you to sign quickly, so if they're saying just sign away your life, this is a legally binding document. You have to pay this money back. And if you offered up collateral, you have to sell whatever it is that you offered up. So just keep that in mind. If they're pressuring you to sell and they don't want to tell you all the terms of the loan, maybe don't take that loan. Long repayment terms just gives your business a little bit more flexibility in terms of paying back the loan. This has to be in consideration with interest rates. So make sure you really understand what you're signing up for. Red flags are going to be if you have penalty for early payments. AMPAC doesn't penalize you if you want to pay the loan back faster. We do not mind at all. If there's a lack of transparency, they're just not telling you what you want to know. Hey, what are the interest rates? Are there any sort of fees that I should be aware of? And they're like, yeah, just sign the document. Just sign the document. Don't worry about it. Again, pressure to sign quickly is another sign that maybe this isn't the best loan for you. Short repayment terms. Most lenders will do it on a month-to-month basis, but watch out if they have it within 1 year, within 2 years. And sometimes they might have those repayment terms be on a weekly basis. So you have to pay the interest every week. So just something to consider. Make sure you're reading your loan terms and pay attention to those loan terms because they might have hidden fees. So just something to be aware of. So try to keep that short and sweet for you. Thank you for tuning into the presentation. Everyone, have a great day.